Okay, so now let us look at the numbers that I was talking about. Here's just the structure again to refresh your memory. And here we get to the numbers. Now the first slide here, or the first set of numbers, shows the net income of Coca-Cola. And remember that the Coca Cola Company, under US rules, the Coca Cola Company and export, Coca Cola export, would have been consolidated for tax purposes, right? So HQ incurred numerous operating expenses, most of which were typically costs that one would have expected to be incurred by headquarters units. After reduction of these expenses and the adjustment for non-operating income and taxes, HQ reported net income in millions of dollars. So it's made $1.6 billion in 2007, 1.425 and 8, and then total 4.311 for the 3 years. Now this is the company that owns all the intellectual property, that does all the strategic management decisions on everything. And now we get to the supply points for 7, 8, and 9. And you can see you've got the supply points down by rows, and then you've got the results by column, right? So for Brazil, the total income for the year was 2.18 billion. For Ireland, interesting, we're talking 7.172 billion, right? So Ireland made almost double what in the total number of years as the Coca-Cola Company and export did. But you can see clearly, I mean, the total for 7 to 9 for Coca-Cola Company and export was 4.3 billion, whilst these contract manufacturers producing syrup made almost 3 times that at 11.551 billion in operating profit. And I must be honest, I don't know whether operating profit and net income here is the same, because for Coca-Cola they talk about net income, but one would assume that the judge would not compare apples with pears. If you then, what happened was, so seeing these numbers, the IRS then engaged an economist, Dr. Nolan, I think his name is, and he came and he said, okay, you know, how can we figure out what these companies are supposed to earn? And he was the one that said, okay, well, I think that the functions of the syrup making companies and the functions of the bottlers are not that different. They both are producing stuff and then selling stuff. If anything, the bottlers should earn much more than the syrup producing companies, because they don't only do manufacturing, but they also do the marketing and sales, right? And then they've got this profit split. So let's look at what their profitability is. And then you can see the middle column is the median for the period 2007-2009. All bottlers together had a median return on assets, not cost plus, right? Return on assets of 18%. But then he noticed very large regional differences. So he said, let me break that down into non-East Asian bottlers, which were generally quite low, the Latin American bottlers, which were quite high, and then the rest of the world, which was kind of close to all the bottlers together, 17.9%. Now compare this to the return on assets for the supply points, right? He determined their operating assets in essentially the same manner as for the bottlers, but added an imputed asset equal to an estimated average of the supply points intercompany receivables. He then divided the operating income by the operating assets to yield the return on assets as follows. And then you can see, I mean, Ireland 214%, right? And then it goes down from there. Mexico is still second last, 94% compared to the 18% that all bottlers got on average, or even the Latin American bottlers for 34%. Mexico still got 3 times that much, and Egypt as the outlier. And then also I need to just note that, I mean, this was the top left block was the numbers that the Newland came up with during the audit, but during the trial itself, he appeared as an expert witness and produced a report, and he actually revised some of these numbers down. So the bottlers actually made 15.8, not 18%, which is even a bigger difference than what the supply points made. And here is another chart produced by the IRS, which says it all. If you look at the column on the left, that is the return on assets percentage that companies earn, right? And then if you look at the bottom, those are the number of companies in the food and beverages industry globally that earn these kind of returns on assets. Now, if you look at the top, I mean, Ireland is at a lonely height with 215% of return on assets. Brazil with 180, Chile with 150, Costa Rica with 145, Swaziland with 128, and then Mexico with 94, and Coca-Cola itself only at 53. So Coca-Cola does very well compared to global food and beverage companies if you look down below, but it does nothing compared to what its contract manufacturers making syrup has been earning, right? And this triggered the judge to say these data, very interesting but correct grammar, these data prompt two obvious questions. Why are the supply points, engaged as they are in routine contract manufacturing, the most profitable food and beverage companies in the world? And why does their profitability dwarf that of the Coca Cola Company, which owns the intangibles upon which the company's profitability depends? And then as a last table, this is just the adjustments that the IRS have made. To the extent the supply point reported that income exceeded this benchmark, the IRS determined that the additional royalty income should have been allocated to the Coca-Cola Company from that supply point. The IRS calculated the additional royalties due to the Coca-Cola Company as follows, and then you can see the different companies had to pay over different years. Ireland, for instance, $6.19 billion dollars for the 3 years, and the total adjustment being of almost $9.5 billion. Okay, now let us look at the court's decision itself, and we'll go through the points in some in detail, some not. The burden of proof. The Commissioner's determination and a notice of deficiency are generally presumed correct, and the taxpayer has a burden of proving them erroneous. And I think this is important to bear in mind. I mean, this is what Coca-Cola had to do, right? They had to show that the assessment was wrong. And then what is the standard of review? When is the assessment wrong? For those who are interested, the court starts with a very interesting history of Section 482. You can see Section 482 has a genesis in the Provision of Revenue Act 1926. And it goes through that, and we're not going to deal with that because we're short on time. But then it says, we held in Asiatic Petroleum that because the Commissioner had exercised discretionary power vested in him and determined that allocation was necessary, the taxpayer had the burden of proof of showing that such determination was purely arbitrary, right? That standard of review continues to apply today. And then later they say, in order to set aside such discretionary action by the Commissioner, a taxpayer must establish that the Commissioner abused his discretion by making allocations that are arbitrary, capricious, and unreasonable. So it is a relatively high threshold for the taxpayer. And in the case of Coca-Cola, it was extremely high, considering the facts and circumstances. And so what they then go on to say is, in cases such as this, involving unique and extremely valuable intangible property, comparable uncontrolled transactions may not exist because they've got a preference for the cut. At least that's what the taxpayer claimed. In order to show that the Commissioner has reached an unreasonable result in such a case, the taxpayer typically will need to establish that the Commissioner employed an unreasonable methodology to reach these results. So then the question is whether the CPM has been an unreasonable methodology to apply for making this adjustment. Okay, so if we now look at the threshold considerations of the court first addresses the 1996 closing agreement, because remember the taxpayer said we relied on this, and so at the outset the petitioner urges that the IRS acted arbitrarily by deviating from the 10-50-50 method to which parties had agreed when executing the closing argument. And the court is very short about this. The short and we think complete answer to petitioner's argument is that the closing argument says nothing whatever about the transfer pricing methodology that was to apply for the years from 1995. And again, this is a classic case of assumption, right? Coca-Cola assumed that it could have gone on with that. And you know, I said before, maybe in a European context they might have, but on the other hand, if you do look at the absurdity of the results that the 50-50 method generated in the 2007 to 2009 years, I think it is fair to say that, you know, a taxpayer cannot expect and rely on a government's agreement if it is manifestly absurd. So maybe this would not fly in Europe either. And then the second argument is the relevant parties and transactions, and this is where Coca-Cola's whole defense falls down. Okay, we'll get to that in a moment. So the Section 482 regulations, the transfer pricing regulations, require that we determine the true taxable income of a controlled taxpayer, right? The Commissioner properly treated the supply points and the SERVCOs as distinct sets of controlled taxpayers that engaged in discrete sets of controlled transactions with TCCC. Remember, they were in separate countries. The supply points made syrup. The SERVCOs helped the bottlers with marketing and sales strategies and stuff like that. And the SERVCOs were in different countries, different regions, different people, right? And the taxpayer, all their arguments, besides the 96 closing argument, based on the fact that they said, well, you should see all of these, because it acts as one business unit, you should see all of these together, and then you should allocate hugely valuable intangibles, marketing intangibles, to the supply points, right? Now, the court quickly says determining the supply points had insufficient compensation to petitioner for the rights to use petitioner's intangible property. The commissioner reallocated income to petitioner from supply points, and then they deal with the arguments of this combination of supply points and service points, and they say, and this you got to go slow, but it makes sense. Petitioner's suggestion that you should combine the service points and the supply points, right? Moreover, entails both duplication and inconsistency. Petitioner would treat the SERVCOs as controlled taxpayers transacting with TCC at arm's length, because they already agreed that the cost plus arrangement that the SERVCOs got were at arm's length, right? Was at arm's length. So they would agree with that, but they would use the BUs as proxies or substitutes for the supply points. So, but then I would say, yeah, but the supply points had huge marketing intangibles, which were generated effectively by the SERVCOs, because the court says, but the BUs consisted almost entirely of personnel employed by the SERVCOs. Petitioner agrees that the SERVCOs were properly compensated on a cost-plus basis for their employees' services. And then petitioner cannot simultaneously contend that the services of these employees justified supranormal returns for the supply points, right? Because the supply points, we saw most of the people only did supply, making syrup, right? Whatever people they were, for instance, in Brazil, who did something extra, they basically did what the SERVCOs did, and the SERVCOs, the taxpayer agreed, was compensated at arm's length. So the court concludes, we will not conflate the SERVCOs with the supply points, attribute the activities of the SERVCO employees to the supply points, or otherwise combine them. And this is where Coca-Cola basically lost the case and all of its arguments. Finally, in the threshold considerations, the court addressed the best method rule, and what happened here was Coca-Cola argued that the CPM is basically a method of last resort and should not have been used. And the court, again, like they did with the history of the 482 regs, go into the history of the methods, and they talk about that there used to be a hierarchy and there isn't a hierarchy anymore. And indeed, the guidelines said somewhere that CPM is a method of last resort, and that's what Coca-Cola clung to. But again, that method of last resort sentence was proved completely out of context, as lawyers very often do. They take 5 words out of a paragraph and pretend like the rest of the paragraph doesn't exist, right? So what happened here was these words were there, CPM as a method of last resort, but it very clearly said that CPM is a method of last resort if there are other facts and circumstances available that, for instance, justify the use of the cut. And the court said, you know what? Coca-Cola has not produced any cuts. There is no reason to do a profit split because the supply companies do not have valuable intangibles. So CPM is a reasonable method to use in this case.